quite timely, of course, that we have you on following this move. How does this change anything for you?
I think it actually overall gives a signal that the regulators acknowledge the slowdown in the growth momentum. And to me, I think from a risk assets perspective, it does sign more from a fixed income and credit side a positive signal that this does put a floor under some of the dislocations we were going through over the course of last few months. And just taking a step back, looking at the policy backdrop in China, the PBOC was one of the very few central banks still running the unorthodox policies or what you would expect from a traditional standpoint. And the tightening in liquidity was very much self-inflicted. So it just obviously tells you that they acknowledge the slowdown and they are there to support the economy, the real economy, if needed.
So you mentioned this could be good for credit. We have seen those Chinese high yields, though the spreads have widened quite a bit for the past few weeks. Do you see a sense of narrowing from here on forward?
So yes, the short answer is we do expect the spreads to narrow from here as we look forward. Fundamentally, we still see the Chinese high yield to be actually on a stable path, in some cases some improvement. We don't expect the default rate to change significantly between now and end of the year. And hence, from the overall spread perspective, it actually provides a fairly interesting entry point. And it reduces some of the liquidity-driven dislocations that we were facing. So it's a positive backdrop for the high-yield markets in Asia in general, and more specifically China.
Would it, and this might be a stretch, but you tell me, Neeraj, would this additional liquidity come into market with the lack of information that we still have on several of the distressed parts of China's credit market, the Evergrandes of the world? Do you have enough information right now? Do you think the market has enough information to take advantage of the very cheap parts of that high yield market?
So I will actually separate out between the top-down view of the high yield markets versus the idiosyncratic risk. And again, taking a step back, thinking about some of the policy drives in China, the overall focus on deleveraging, the focus on real estate sector with the 3 red line policy, the moral hazard issue, the technology sector focus, I don't think that's going away. So you might not have as much of an idiosyncratic shift that you are looking at, but from a broader sector perspective, which was seeing a pressure and the widening, that should start to come back. So that, I think, is the overall view I have, is the market beta turns obviously more on the positive outlook from here.
How have your positions changed then, Neeraj, since this R cut? If you look at within EM Asia, are there particular countries that you're focusing on now?
So from a credit standpoint, we like China. So we have added to the positions across investment grade and high yield. In the dollar space, we continue to like the onshore market in China across rates and credit. In rest of the region, again, from a high yield standpoint, we have a strong preference for Asian high yield over investment grade right now, which in a way, in fact, the R cut reinforces that view that we will see more supportive backdrop for the Asian high yield markets between now and end of the year.
A little bit more on that, Neeraj. So, so you mentioned your preference. There's India, Indonesia, China, of course, you've outlined that as well. It's unhedged, though, in terms of your recommendation. They're FX unhedged. Would that also be reflective of your views on the dollar against those specific currencies?
That is correct. From a broad dollar standpoint, we expect actually the dollar to be sideways from here. So I don't expect any major changes in terms of the direction of the dollar. And on the other side, from an Asian currency perspective, we do like Chinese yuan, we like Indian rupee, Indonesian rupiah, onshore duration on an unhedged basis. So it's a combination of the rates and the FX view.